Welcome to Market Movers. I'm Jim Urio with Bob Iacchino. Bob, glad to have you.
Good to be here.
Okay, so on Tuesday we saw a CPI number that was a hair higher than expected. I don't want to blow the whistle on inflation, but we also see a yield curve that clearly doesn't worry about inflation at all. As a matter of fact, it might be telling us that deflation is a worry. What is the yield curve telling us?
Yeah, it's worth mentioning that uptick, but still the year over year is 1.8%, not where the Fed wants it, not even close to moving that way. That's what the yield curve is showing.
Okay, so now the Fed sees the inverted yield curve, and I know that's all over the news. Are they sitting back and say, we got to ease more aggressively to try to steepen out the curve, or do they care?
Well, I think to a certain degree it forces their hand. And again, with the low inflation that we're at year over year, I think it gives them the room to do this. So yes, I think they have that discussion.
Okay, now before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. When we price these trades out, they're both off the December underlying 10-year contract, was trading about 131.02. Bob?
So I think this can turn on a dime. So as an example, I'm going to look at a put spread. I want to buy the October 130, 129.5 put spread for 9 ticks. Trade risk is about $140 to make a potential $360. It's important. This is an October option that expires on September 20th.
Is this just counter trend? It's gone too far too fast?
Yeah, it's too far too fast. And again, I think it's extemporaneous factors that are causing these things that can reverse just as quickly.
Well, okay, so mine, I hope you find it interesting, because I did. Because I also think it's gone far and fast as well. So I think that just buying a call spread, if you think it's going to continue in that direction, was too expensive. So I looked at a call fly, which I do on occasion. This is the week 5, so it expires on August 30th. So it's buying one call spread to sell another. The one you buy is the 131.5, 132 call spread, so that's 50 wide, and then selling a 25 tick wide, 132, 132 and a quarter. And you pay 6 ticks for this, so it risks $94 to make a potential 406. And what I liked about this is that a normal equal distant call fly, if you paid 6 ticks for it and then it blew through all the strikes to the upside, you lose your 6 ticks because you make on a call fly and lose on the same amount of call fly. This, if it blows through on the upside, you still have 50 minus 25, so 25 ticks minus the 9 you paid. Thoughts?
Yeah, so obviously we're looking at different directions, although we have a little bit different duration. Mine's a little longer, but I love the structure. I think that's one of the places you bring a lot of value, is creating these structures. The structure of going long there for this point in time is very, very well done.
Okay, cool. Now, so there's $15 trillion of negative yielding debt. When you consider that, do you think that's a major reason why our yield curve is inverted?
Yes, I think that is the major reason. The entire German curve is negative. So money that has to buy bonds is coming into the U.S. to get the little amount of yield you can still get here.
Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.